Now in this lesson we'll do a rent versus own purchase, and again I'm going to move through this so that you just get a feel for how this flows. So create a new client plan is my first step. I want to click on rent versus purchase because that's what I want to compare. It's a young couple, they're buying their first home for $150,000. Under add details, how much they have available for savings. They have about $9,000 saved up right now. They'd like to put 5% down. So I can already see they're going to need to borrow about $142,500 and $7,500. This is video 5, sample renter purchasing. Come down here and put in sample, put in their name, renter purchasing. They have $67,000 a year. They're in a 22% tax bracket. And it's sample renter at gmail.com. And I just want to make sure I have a good number over here to get back to them. Renting now, want to qualify to purchase a home for $150,000. That's kind of my notes. I talked to them. Most important thing is cash flow right now, and could get additional down payment support if needed. All right, so that's it. So I'm done. I'm going to click on the borrow tab. Come into my borrow thing. I'm going to have some stuff already up here. Oops, I'm sorry. Missed the most important thing, add liability. And I want to put in rent. So they are currently renting. And they have a landlord. And they are paying $900 per month. And again, whenever you see that box, just go ahead and hit it and say, what's the annual increase? That would be the cost of inflation, let's say 2.5%. And they pay $35, or let's say $30 a month for renter's insurance. And those are their two primary rental expenses at this point. I'll tell you what, we've got one other one. They also pay $25 a month for storage, which they wouldn't have to pay if they bought their house. So that stuff gives me my little adjustments to the rent, and I'm good. Now I click the borrow tab. So I've got currently they're renting, and we are going to pay that off because we won't continue to have that as an expense, right? That $955 a month is going to go away. And what's it going to be replaced with? And you know, with home buyers, I like to keep things really simple. I'm just going to show a 30-year fixed as my scenario here, and I'm going to go ahead and just do a first position 95%, 142.5, 3.895%. And again, you just see how as you go through this, taxes, insurance, all look good. My MI is going to be about 0.87, and maybe I'll compare this to, this is not an FHA, this is a conventional, and I'll just click save. Now I'm going to go ahead and compare this to, I'm not FHA example, expert. I'll do a 30-year fixed FHA, and I'll just bring all this down. So it's fast. I quick copy this down, and I think we're about 96.5 on an FHA, and we'll say the interest rates are the same, and we'll click FHA. So it's going to treat everything. It will stop after 60 payments or an LTV of 78% for the FHA. Everything else is going to be the same. So now I've got my nice two side-by-side comparisons, but let's say there's a 1%, 14, one, I may be doing this wrong, but just to give you a feel for how to do it, 1447 is the tab. That's the amount that I'm going to finance in. So I want to put this below. It's a closing cost. Okay, so I'm going to put this in here. I'm going to put this in here as an X. So I'm going to add this in. I'm going to go 3,947.47. So that's what I'm going to use for my closing cost number. But I'm going to finance this in. So I click Add to Loan, and watch what happens. You'll notice this takes it up to the LTV up, but it adds that into the loan amount. So now I've got the 1447 added into the loan and financed into the loan. But now I've got a nice clean accounting here. My total closing costs are still going to be 3947, even though 1447 for that MIP is going up top. So I've got a little higher closing costs. Down payment here is a little bit lower though. Closing costs are a little different. Cash needed 10,000, 9,197. They have 9,000. So here again, I've got quickly my net cash close. I need another 1,000 with this scenario. I need really less than a couple $100 in this scenario. If I keep renting, my current situation is renting. So I've got 9,000 cash. If I keep renting, guess what? I get to keep the 9,000 cash. How about cash flow? 900, 953, and 1925. That seems a little bit wrong. Let me see where I did something wrong here. You'll see something, you go, okay, it did 1925. That doesn't seem right. We'll look up here and look into the payments and see where I might have made a mistake there. Oh, I didn't pay off the rent, so I didn't click yes. So it's still showing the old rent being there. So now I want to take that rent away, because if you finance on the new property here, we won't have to pay this rent. All right, so now the rent's gone, because in either situation, I'm going to pay the rent off. So I've got a payment of 953 or 970. So again, with the MI factored in and the upfront and the financing, I can still see the cash flow difference. This is where I really like tax adjustments. We haven't talked about that yet, but if I expand this, it shows each payment on an after-tax basis. So 900 in rent is 900 after tax. 953 on a 30-year fixed pre-tax is actually 798 after tax. And 970 pre-tax is really 813. So now we're showing the tax benefit, and this is really a good way to compare rent versus own. This green means that they're going to be able to buy this house and have somewhere between $102 and $87 a month in cash flow. But which is best for this client? The only way to know that is to come down below, click refresh, make sure we've got our highest payment in here for each scenario, which is $970.15. They think they're going to be in the house for about 7 years, 2% appreciation growth, 5% sort of an after-tax savings rate. Remember, we'll default to repaying. And this goes through and does all the math. You're going to spend $81,493 in rent, $81,493 in each of these three scenarios. I can look at the house value and the mortgage balance, which I don't have here. Savings balance is negative because I actually am having to spend more than this because my rent's going up and my house payments are staying the same. So that's another cool story to tell. So your client's going to be better off by $64,866 buying this house versus renting over 7 years, or $61,070 buying this house versus renting with a FHA. So which of these is better? The 30-year conventional in this situation is a better deal for the client, okay, over a 7-year period. But I can see months of debt-free, 344 versus 321. If they thought they were going to be here for longer, let's just say 30 years, see, this is cool. I can go on out, 600 versus 617. So over time, the FHA actually in this case is going to play out to be a better solution for that client over the extended term. But if their time frame is just 7 years, that's where this is so valuable. I can see what the best solution is over just 7 years. And I'm done. Can you afford this? Yes, you have the cash to do it in either situation. You're a little better off here on the cash flow. You're a little better off here. Financially over 7 years, you're going to be a little better off with the 30. But either way, you've got that ability to show them this scenario right away. So I hope this helps. From here, if I'm not doing this live with a client in my office, I'm going to come over here and either print it as a PDF, as a web PDF, or as a live demo, depending on how you want to build that report. And again, knowing your client, do you want to do a simple 2-page summary and just give them something real clean and simple? Or do you want to go ahead and give them a really nice comprehensive report? And buying a house, I may want to check this because this is a first-time home buyer. Buying a house may be relevant. Maybe I also want to go ahead and teach them a little bit more how to borrow smart, repay smart. I click those two and I build my PDF, and it's going to bind all those together now into one nice new report. And there we go. I've got a 25-page report I can build for that client to really show them what I did for them. There's your rent. Here's your different options, closing cost impact, monthly payment difference, your time to be debt-free over time. Here's your new scenario here comparing the 7-year ARM and equity line of credit, or whatever of the two. I actually clicked the 7-year ARM for recommendation. There's the program matrix, equity line of credit, client information, current liabilities, AM tables, and here's my attached information. Borrow smart, repay smart. So I've got a nice little read for them there. And I've also got a nice little read for them on buying a house with some of the key things to think about when buying a house. So I was able to build them a nice report here, 25 pages, and this whole thing with narration was 7 or 8 minutes. So you can get through it much faster as you get comfortable using the tool to create a really compelling solution for the client. So that's an example of how to take a renter and convert them to a buyer very easily.